Hey guys, Dave Keller here with Market Misbehavior. I love to ask interviewees what their one chart would be. And that is, if you had one chart, just one chart, besides a regular chart of the S&P 500, as a way to understand the broad market environment, what would it be right now and why? So here is my one chart for today.
Okay, for today's one chart, we're looking at the US dollar index, dollar sign USD. Now, the dollar, some would argue, is the most important thing you should look at. And when I was first learning technical analysis, in particular intermarket analysis, as John Murphy described it, that was the chain of events that you were taught to understand. Currencies were most important. So, number one question you want to answer was, what is the dollar doing? That would inform your analysis of commodities and sort of inflation, right? Where commodity prices going up or down, and then that would relate to interest rates and fixed income instruments, bond prices, and then finally, stock prices would be the last one. And that was sort of the order of operations. Stronger dollar meant weaker commodities and sort of this chain of relationships. As I was learning charting, that was a simplistic way of understanding the relationship of the dollar to everything else. And overall, over the long term, that has, it's playing on the traditional relationships of these different asset classes. One thing I've learned, though, in 20 years of using charts to try to understand market relationships is that hard and fast rules like strong dollar means strong stocks or something like that is oversimplifying in a big way, right? And then the reason is because none of these relationships are occurring in a vacuum. The game is not you have two assets, the dollar and the S&P 500, and you just need to figure out how the two are related. There are, many different asset classes, and there are many different components of those asset classes and macro headwinds and tailwinds that will impact each of them in many different ways. So I think it's important to understand intermarket relationships, and it's important to look at, even if you're an equity investor, to look at currencies and commodities and interest rates because they provide, in my opinion, headwinds or tailwinds to equity performance. So if your goal is to understand what the S&P is doing and how it's evolving and where there might be potential for changes, I think looking at some of those other asset classes and anticipating how movements in those assets like the dollar could impact stocks, I think can be very, very valuable. Having said that, let's look at a chart of the dollar index. We're looking at the last 2 years. And the first half of the chart is really showing this consistent, slow and steady uptrend that the dollar saw really through the end of last year, the end of 2020, really into the first quarter. And you can see with the blue arrows, I've indicated these consistent pullbacks. And there's this pattern of pullbacks right around the same distance that would then resolve back to the upside. It was enough of a pullback that the uptrend would resume. And that was sort of the pattern that I saw in the dollar. All of that changed along with most asset classes in 2020. And I remember giving a presentation in mid-February, and everything was going up literally. Dollar was strengthening, gold was going up, bond prices were going up, and stock prices were going up. And my comment then was this is unsustainable. At least, something's got to change. These things are not designed to move all in tandem like this. And sure enough, we saw different things break. The dollar broke quickly to the downside in late February. Stocks obviously did as well. And the dollar bottomed out here in early March, then rallied significantly to top out here. The top in the dollar index was here right around March 23rd, which is when stocks were sort of hitting their bottoming point. So let's focus on what happened after that, and call it, sort of think of this as a market shock. That whole February to March decline really shocked a lot of assets. There are these big exaggerated fluctuations in most of the charts. Then we sort of settle back in to a normalized movement. And when you eliminate that noisy period, you can see that we've essentially rotated from a strong dollar environment to a weak dollar environment. You can sort of chalk up that, February, March, April period as sort of the transition, right? A really choppy, noisy transition, but in the end, a transition from stronger dollar to weaker dollar. And since then, we've had a weaker dollar environment with lower highs and lower lows that has persisted through, through this week, essentially here in mid-September. Um, if we focus a little bit more on the chart, we can see some interesting themes. So one of the patterns we saw here in June, highlighted by these pink dotted lines, is a bear flag pattern. And that's basically when you have a big down move, you then have a corrective pattern, meaning a move against the longer trend, and it is a parallel retracement. So higher highs and higher lows on the short-term time frame that are moving against the longer-term trend. That usually happens about midway through a trend. So if I start the clock here with this purple arrow here at the peak in May, go down through this bear flag in June, and we take that as the first half, then this is the intermission, and now we have the second half, and now we're in the post game of this downtrend. That's, again, this is sort of treated as a minimum objective is how you describe it. We're probably going to get at least to there, and then we would look for signs of bottoming. Now what's happened, if you look at the dollar now, we've continued to go weaker. And again, until proven otherwise, as a trend follower, I'm going to assume a weaker dollar. However, we're seeing signs of potential inflection point, a potential bottoming pattern. And in particular, it's looking at a bullish divergence. So this is the price making lower lows, the value of the dollar index going lower from July, August into the beginning of September. You can see the RSI, a measure of momentum, is actually doing higher lows over that period. So what that speaks to is, the price continues lower, but the momentum on each downside thrust is less and less severe. That's usually what happens at a bottoming point. The opposite would tend to happen at a topping point, where you see higher highs in the price and lower peaks in the momentum indicator in the oscillator. Maybe back here in late 2018, you could argue we saw that with the dollar index going higher and the momentum, the RSI, sort of sloping downwards over that same period. So what it does for me, this is, for me, has never been a, we have to assume a stronger dollar here. It puts it on the list, puts it on the watch list. A break to new swing highs, a break above the previous swing high, which would be the dollar index needs to get above 93.50, ideally above 94, which would take it above the high from early August. Also take it above a declining 50-day moving average. That would, for me, signify a completed rotation from weaker dollar to stronger dollar. This bullish divergence puts it on the watch list of looking for that move. We're seeing the momentum characteristics that often will line up with bottoming patterns. Now we just need to see if the price follows through to the upside. Here's the kicker, though. The dollar has been weakening basically from the market bottom in March to the price low here. Traditionally, a weaker dollar means two things. It would mean that U.S. stocks are most likely underperforming global stocks, and it would also mean that small caps would be underperforming large caps. And that's, basically because of what a weaker dollar environment would mean, all else being equal for the environment. A weaker dollar usually suggests a weaker economy. And because this is the dollar not weakening versus itself, it's weakening versus a basket of other currencies. So that means other currencies are stronger than the dollar over that period, which, again, generally speaking, the general assumption would mean that means the economic conditions are more attractive in other places. And that's why the other currencies are strengthening versus the dollar. What we've not seen is that play out here since the March low. Since the March low, overall, this outperformance in U.S. stocks that came along with the stronger dollar environment, which made sense, actually persisted for the most part with this ratio. And this is the SPY versus ACWX, which is all country world ex-US. So this is basically the US versus everything else in the world. That ratio actually made a new swing high the first week in September. This is after the dollar had weakened for the last 6 months. So that general assumption of weaker dollar means underperformance for U.S. stocks has not played out. It speaks to really the dominance of U.S., especially U.S. mega cap technology communication services, really driving equity prices higher. Also, again, small caps versus large caps has fluctuated, but overall has been leaning more towards mega caps away from small caps. If and when we would see a stronger dollar environment, again, the general playbook would mean you would assume U.S. stocks would most likely outperform non-U.S. stocks, and small cap stocks in the U.S. would most likely outperform large caps. And we're just potentially starting to see the emergence of relative performance of small caps improving. So that's certainly one thing to look for. So overall, my conclusion with this chart is we're starting to see the signs of the potential of a strengthening dollar. I would caution people in oversimplifying what that would mean. I hear a lot of things saying stronger dollar means U.S. outperforms, small caps outperform, done. And I would say those relationships, as much as we'd love to assume them to be incredibly consistent and highly correlated, they're not. And so the way I think of it, there's still value in knowing and understanding a potential trajectory for the dollar. What that tells you is a general bias, tells you a general headwind or tailwind. So a stronger dollar from here would mean a headwind or a tailwind for U.S. outperformance. That would mean the conditions are ripe for the US to continue to outperform, and the conditions are right for small caps to outperform. But most importantly, you need to look at the charts and see what's actually playing out, because the dollar is not the only game in town. It's not the only thing to be looking at. There are other influences that can certainly cause any asset price to fluctuate one day, 1 week, 1 month to the next. Hope you found this a helpful rundown of the weakening pattern in the dollar, the potential for a stronger dollar in the coming weeks and months. From everyone at Market Misbehavior, hope you have a Market Misbehavior. Hope you have a great week and stay safe. Bye now.